Hey traders, listen carefully. If you're trading with prop firms and still focusing only on strategy, you're already playing the wrong game. Today, I'm going to show you the best risk management system for prop firm trading. Because here's the truth. Prop firms aren't designed for you to win. They're designed for you to break their rules. But once you understand the right risk management, you can flip the system in your favor and make money consistently. Stay till the end, because this is what truly separates funded traders from everyone else.
This video is going to be about how I trade funded accounts. For this example, we're going to use a $25,000 funded account, but this exact approach can be applied to any account size and any drawdown model. Now, the first thing you need to understand is this. If you have a $25,000 account and the max drawdown is 10%, that means your real trading capital is only $2,500, not $25,000. So let's break that down. If you risk 1% of the full account, that's $250 per trade. With a $2,500 drawdown, it would only take 10 losing trades in a row to blow the account. That's why I don't think in terms of the full $25,000. I think in terms of the actual drawdown, which is $2,500. Now, when it comes to risk management, it really comes down to one simple question. How many trades can you afford to lose before you lose the account? If you look at this table, you'll see different risk percentages and how many losses they allow. Risking 1% to 4% gives you plenty of losing trades before failure, which is safer. But the downside is that it can take a long time to get funded, especially since most prop firms have time limits. On the other hand, if you start risking a lot more per trade, yes, you might pass the challenge faster, but you also increase the chance of blowing the account if you lose 7, 8, or 9 trades in a row. Personally, I believe the sweet spot is allowing myself 10 to 20 losing trades before losing the account. If we take the middle of that range, around 14 losses, I'm confident my system will not lose 14 trades in a row. So for a $25,000 funded account with a $2,500 drawdown, I personally risk $175 per trade. That risk level allows me 14 consecutive losses before failing the account, which gives me enough breathing room to trade confidently, stay disciplined, and still pass within the time limit. If you have a fixed risk-to-reward ratio of 2 to 1, and you're using the same position size on every trade, you only need to win 34% of your trades to be profitable overall. Now, if you increase that to a 3 to 1 risk to reward, you only need to win 30% of your trades to stay profitable. That's why risk to reward is so important. You don't need to be right all the time. You just need a system where your winners are bigger than your losers. As long as your risk stays consistent and your execution is disciplined, even a relatively low win rate can still produce consistent profitable. So, as a visual way to understand risk to reward and win rate, let's break this down. If on every trade you risk $100 to make $100, a 1-to-1 risk to reward, you need to win 1 trade for every loss just to break even. Now, if you move to a 2-to-1 risk to reward, where you risk $100 to make $200, you only need 1 winning trade to cover 2 losing trades. 2 losses put you at negative $200, and 1 win brings you right back to break even. If you're trading a 3-to-1 risk to reward, even if you lose 1, 2, or even 3 trades, a single win will cover all of those losses. And when you get to a 4-to-1 risk to reward, you only need a 20% win rate to break even. This is why risk to reward is so powerful. You don't need a high win rate. You need consistency in risk and patience to let winners run. So, keeping all of that in mind, this really comes down to what suits you best as a trader. The best way to figure that out is by backtesting your strategy. Look at what risk to reward your system naturally delivers most of the time, and then figure out what win rate comes with it. You can scale your risk to reward, but you need to track how those changes affect your win rate. There's always a trade-off. Now, one important thing to be aware of. If you're using fixed risk per trade, set stops, and consistent position sizing, and you still manage to lose 15 trades in a row, that's a clear sign that something is wrong, either with market conditions or with your execution. If you're following your rules properly, you shouldn't be blowing accounts.
Consistency is everything. Same risk, same position size, same rules, every single trade. And if you're thinking about buying a funded account, check out the links in the description. I've listed multiple prop firms along with coupon codes that can give you up to 55% discount.
That's it for this video. If this helped you, make sure to like the video and subscribe to the channel. If you want to join my mentorship program, the link is in the description. And if you have any questions or doubts, you can join my Discord. I'll see you in the next one.